Good morning and welcome to another episode of Money Matters with myself, Realtor Randy with the Mendez Home Team at eXp Realty, along with Sharon Thompson at Alameda Home Mortgage. Good morning, Sharon.
Good morning.
I feel like it's been forever.
I do too. Skip
But
1 week and it's like,
1 week and it's like, where the heck have we been all of our lives, right?
yep.
Well, I'm excited because we are continuing our topic on what to know before buying your first home. And so we're going to just kind of dive right in. And this is one, I'm going to pull up the slides real quick. This is one of those that, I think it seems so basic and elementary to us because we know how buyer's agents get paid, but I can't, like the consumer often is like, okay, well, how much do I pay you? Where do I pay you? What are your fees? And so one of the first things we want to talk about is that, the reason, one of the benefits in having a buyer's agent is that that's not even a cost that you have to absorb as the buyer, right? So we actually get compensated by the seller side. And this is something I share with all of my clients. I've been doing this for 18 plus years, Sharon. And there's only been one time ever that I was actually compensated by my own buyer. Love them to death. Still have a great relationship with them. I think they actually hold the record for the most showings that we ever did. And then they came to me and said, "Hey, Randy, I think I want to buy my rental." And so I called their landlord and I negotiated it. And she was like, "Well, I'm not paying you." And my clients were like, "It's fine. We'll pay you. Just get us this house." And so we did do that.
Oh, that's pretty cool.
Yeah, it was really cool. And they're still in that house and they're a great family and it worked out. But I just laughed because, after like 65 showings or something crazy, she was like, okay, so I think I've learned that I like my own house. So it's just one of those funny things. So we're just kind of starting off with number one no is that, when you're looking for buyer's representation, that's not going to be one of your additional costs. However, there are closing costs, and Sharon's going to talk a little bit about those.
So kind of the same thing whenever a client comes and sits down with me and we pull credit and everything else, they ask me the same question, well, what do I owe you? And I said, you owe me nothing. I don't get paid until the deal closes. Same thing with a real estate agent. We don't get paid until the deal closes. Once the deal closes, then money exchanges hands, but it doesn't come out of your pocket. We talk about closing costs. There are closing costs involved. And in the past, I would say that, a lot of times we were able to negotiate these closing costs with sellers a little bit. We were able to, put some relief on the buyers. In today's market, we're not really seeing that. That doesn't mean it won't come back. But in today's market, we are having to be more prepared for closing costs than ever. Closing costs are set by the title company, and typically the seller will pick the title company. That doesn't mean the buyer doesn't have a say in it. They absolutely do. And every title company varies a little bit, but as far as closing costs are concerned, they're pretty well set. Like I said, the title companies will be varying, but their fees are pretty similar. Title policy, escrow policy, the recording fee is exactly the same across the board. The recording fee is, based on your county and what your county charges, and that's a set fee. And then there's some other things that are negotiable, like do you want to do inspections? Do you not want to do inspections? And those are part of the closing costs. And then you have some of the lender fees. And lender fees are usually, I would say, they vary by a couple $100 across the board per lender as well. And then also setting up your escrow account, which is your taxes and insurance. That is actually also a closing cost because we have to make sure that your insurance is paid for 1 full year and that we're ready to go when your taxes are due. So depending on the type of property you're buying, closing costs will vary on purchase price, title company, and per lender.
And now that we have their head spinning, just know that the really good news is that this is, again, something that we help you walk through. I say this all the time, that buying a home can often be a lot like drinking water from a fire hose, and we don't want that to be your experience. But we do want to just kind of help you to absorb more information throughout the process and then to know what to be prepared for. So when you do get that consultation with your lender, one of the things that's going to be awesome is they're going to be able to give you some estimated closing cost. And so you're going to then understand like, oh, okay, now I understand what these are. And then when you're working with your agent to structure that offer, we're going to talk about, okay, are we going to split these fees? Are we going to ask them to pay all of these fees? Are we going to absorb some of these fees? In this market, it's very normal to absorb more fees on the buyer side just to make that offer that much stronger. And so now you're going to kind of understand, okay, these are those items that we're talking about. So moving on to our next point, you may have to pay mortgage insurance. And so this is a hot topic that I think, especially in this market, that we're having a little bit more conversations around. I personally handle a large amount of clients that do want to avoid MI, also known as PMI, and they just don't want to pay that, right? They don't want to have that. Insurance going to explain what that is. But in this market, we are having conversations about, does it make more sense? And are you going to have more competitive advantage if you're willing to use some of that down payment and use that towards competing, and then you'll end up back with MI. So Sharon, tell them a little bit about what MI is.
So mortgage insurance, a lot of people get that confused with homeowners insurance, and they are absolutely two different things. When you put less than 20% down on a house, basically the lender looks at that as a risk. So what mortgage insurance is it's insurance that you're not going to foreclose. And I tell every client this: it doesn't benefit me, it doesn't benefit your agent, it doesn't benefit them. Mortgage insurance literally benefits nobody except the bank. It is an outside insurance policy that if you foreclose, then the lender does not lose on your foreclosure. And anytime you put less than 20% down, you're subject to some sort of mortgage insurance, whether it's an upfront fee or a monthly fee. And the more you put down, the smaller that mortgage insurance goes, because it's risk based. And what that means is that the more skin you have in the game, the less risk a lender has. So therefore, mortgage insurance will come down based on that risk, between 3% down, 5, 10, 15% down, whatever that number is. That will decide the risk and the price of the mortgage insurance. Like you mentioned, Randy, we are negotiating this more than we ever have in the past. In the past, it was like, this is what I have for a down payment. This is what I'm buying the house for. Bada bing, bada boom. Here's our numbers. We are doing way more negotiations these days. We are doing way more playing with the numbers than we ever have in the past. And similar to what you said, a client may be wanting to get rid of MI and come in with 20%. But if we have to be aggressive in our offer, we might have to use some of that down payment to make up for an appraisal, adding MI into the situation. And when we talk about equity and we talk about building equity in your home, that MI isn't as scary of a number when it's like, okay, well, we got to use 5% of your down payment. So now you're gonna have a little bit of MI. It's like $70. It's like $60. It's like $50. And what's that difference as far as like getting into the home or not getting into the home? We're also negotiating a lot more upfront MI. I'm doing that more and more today, where we're having clients pay the upfront MI. It makes a huge difference. Paying it upfront saves people thousands and thousands of dollars. So that's more talks that we're having today than we used to as well.
Yeah, without a doubt. So bringing us to our third slide, your mortgage covers more than just your house payment and interest, right? And I think that this one also, people are like, oh, it's not just because they get on calculators. So my experience is I have clients that get on these online calculators, and then they say, well, I did the math, and I'm only going to pay $1,200 a month for this house. And I'm like, where did you get that number? And they're like, well, I got it on a calculator on the web. And they don't know that there's other things to account for. So Sharon, what are those other things?
Well, we hear the term a lot, PITI, and it's like, what does that mean? PITI means principal, interest, taxes, and insurance. So you have taxes, and you have your homeowner's insurance, and then a lot of times you also have an HOA, depending on where you buy. And so we have to take all of those things into consideration when we talk about the difference in rent and a mortgage payment.
Yeah, now the HOAs are not actually paid. So when you're writing the check, your PITI, when you're writing the mortgage check, is going to be covered, but your HOA is going to be a separate invoice or a separate bill that you do pay, correct?
Correct. But when considering a full mortgage payment and what your
Right.
budget can handle, we do want to consider that. Yes, absolutely.
Right.
But it is a separate bill that you pay on your own. And we make sure everybody knows that, because we don't want to call in 6 months with delinquent HOAs because they thought we were paying it.
Correct. And also, this is where, an HOA can diminish your purchasing power. So this is where I have a conversation with my clients that they need to understand that sometimes they're not comparing apples to apples. So for instance, if we're looking at a property with a high HOA versus a property without an HOA, 9 times out of 10, the property with no HOA can actually be a higher purchase price than the property with an HOA, because the HOA is going to diminish that purchase power.
Correct. Absolutely.
Yep. And so that's one of those things. So we're trying to keep this bite size for you. So we're doing three pointers at a time and 3 kind of ahas at a time. So on that note, we're going to wrap it up. But as always, if you do not already have a stellar lender or a fantastic realtor that are walking you through this crazy, insane, unprecedented market, we would love to earn that opportunity. You can always reach me directly at 775-379-8344. And you can reach Sharon at
949-201-8940. And I just want to add one quick thing, Randy. I remember way back one of our first shows that we did, we talked about the inspection and this day and age being the honey-do list. And I can tell you, I probably used that term. I'm like, listen, we're going to get an inspection, but this is pretty much your list of what you're going to do after the loan closes. We call it the honey-do list. I swear to you, I probably use that once a day now. Every day.
I love it. I love it. I will not invoice you for it. But yeah, no, I mean, I've had that conversation, and it's kind of a tough conversation to have, and it's just the reality of the market that we're in. But the bottom line is, if you have skilled professionals helping you dive deep and look at every angle, understand every angle, so that you can make that aerial view decision. What you don't want to make is a decision with limited information. You're gonna have success in this market. It might take a little while. So to our clients out there watching that are in the mud right now, we know it's going to take a little while, but we will get the job done. So thank you guys for tuning in, and we'll see you next Friday. Bye.